Hey class, today we're going to be taking a look at Chapter 3, Adjusting Accounts for Financial Statements. And before we get into the adjustments, we'll take a look a little bit of why the adjustments are needed to begin with. And that's because under GAAP, we're using something known as accrual basis accounting. So unlike cash basis accounting, when revenues are recorded when cash is received, and then expenses recorded when cash is paid, accrual basis, we're looking at when the services are provided. So cash might be received before those services are provided, contemporaneous with it, or cash might be received after the services are provided. But our revenue recognition principle says that we're going to be recognizing that revenue first when the goods or services are provided to the customer and when there's an expectation of payment from that customer. Another GAAP principle says that those expenses, we want to recognize them at the same period as the revenue recognition. So, for example, if we were selling a cup of coffee and we provided that cup of coffee to the customer, we'd want to record the revenue when the cup of coffee was delivered, regardless of whether the customer might have come in early to purchase a gift card to come back later, or whether the customer might have gladly paid tomorrow for the cup of coffee today and put that cup of coffee on, say, a tab or something like that to come back another day to pay. We're going to match the expenses, so the paper and the cup and maybe the plastic and the lid, in the same time period as when that cup of coffee was delivered and provided to the customer. Now, this timing issue that exists with when the service is provided and when the matching expenses are also lined up at that same period, you're going to have four different situations. So with the revenue recognition, if revenue is not recognized at the same time and when cash is provided, there may be a timing issue if cash is provided by the customer early or cash is provided by the customer after the fact. And recognizing expenses in the same period as that revenue, there's also a timing issue with expenses to where we may recognize that expense after the cash is paid for some of those materials or before it's paid for some of those materials. And we're going to go through each of these four timing issues and an example of each. So the first is going to be a deferred expense. So this is going to be a prepaid expense. This is something where the cash is being laid out or paid by the company, but we're not taking the expense quite yet. An example of this might be prepaid insurance. So if we are paying for the next 2 years worth of insurance, but it's not covering the period in which we're paying, we cannot take it as an expense quite yet. So we'll store that value of $2,400 in this example on our balance sheet, and we'll call that account something like prepaid insurance. So that $2,400 is going to be for 24-month in the future. Now, the next step for this prepaid insurance to kind of show how it's going to work is over the course of that 24 months, that insurance is going to get used up. And then the expense will be taken as it is used, as the service is provided by the insurer. So after the first month, for example, the company will be able to record an insurance expense on its income statement, and that would be our debit. And then we'll credit some of that asset to where the prepaid insurance would, instead of being a net amount of $2,400, would be a net amount of $2,300. So the ending balance after that first month for prepaid insurance is going to be $2,300 as it gets used. And on the income statement, we're going to see that $100 expense. A similar situation might occur for revenue, in which we might receive cash ahead of when we provide those services. An example of this might be if we issue a gift card, or if customers come in to want to put money on one of our apps, just to make it more convenient once they use once they purchase that product at a future point. Another example where it tends to come up is if someone's prepaying for tickets to an event that they're going to go to, but the event hasn't occurred yet. What we're going to do is list it as an account. We've received the cash, so we'll have cash as a debit. but we cannot record revenue quite yet. So we'll list the account as a liability, referred to as something like unearned revenue. So let's take a look at this example here. We've got a 60-day fee that's being paid in advance, so it's covering a future period of time. And then we're going to earn that payment as that time passes. So 5 days service earned would be 5 of those 60 days. It's a $3,000 fee, so $250 of that $3,000 would be earned. So for our unearned revenue, we would list it as a liability, which is going to be a credit. As we earn that revenue, we're going to debit the unearned revenue account by $250, and we're going to credit our revenue by $250. So it's going to give us an ending balance for unearned revenue here of $2,750. And we'll include that $250 revenue on our income statement. And here in this example, having a total of $6,050 in revenue. Now we can have a timing issue with cash in the opposite direction. Let's take a look at that for expenses. Here we may have costs incurred in a period that are unpaid and unrecorded. So we've incurred the expense itself, but we have not paid it up front. So one example of this might be to where if we have workers working, so we've incurred a salary expense or a wage expense, but if we don't pay those workers until the end of the month or the end of the week, then we're going to have a liability that gets recorded as a salaries payable or wages payable until the actual cash payment is delivered. So let's walk through an example for this for our accrued salaries, to where if we pay employees $70 per day, that's going to be $350 for the week. And then if we make payment at the on Wednesday, so 3 days salary is going to be owed. That's going to be $70 times 3, so it'd be $210 of the $350. We're going to need one of those adjusting entries. So we'll have salaries payable of $210 for the adjustment, and then we'll record salaries expense for the $210. So this is for the 3 days that was worked. So we've got our balance sheet showing $210 of salaries payable and the expense statement. Now once the salaries are actually paid in cash at the end of the week, we'll debit off that salaries payable amount. So once we have our $210 payable, which is recording through that Wednesday, we've incurred the expense for it on the income statement. When we make payment, we will pay the salary expense for the remaining $140, as well as that $210. And we've got a similar adjusting entry for accrued revenue, to where if we earn revenue but haven't received the cash yet, so the customer comes in to purchase maybe that cup of coffee and says, hey, I'd gladly pay you tomorrow for what I would like to take today, then we're going to record as something like an accounts receivable. So here we've got a customer agreeing to pay $2,700 for future services. There's 20 days worth of services that have been provided and earn $1,800. And the adjusting entry increases an asset, which is our accounts receivable. So once those services are provided but cash not received, we're going to record the credit of revenue, and we're going to have to record something as our debit. We haven't received the cash yet, so that can't be it. So we're going to list it as an accounts receivable as that asset. So here for the $1,800, we've listed our credit as $1,800 in revenue, and then our debit's going to be $1,800 for the accounts receivable. And once cash is paid, a portion of it, then we'll credit the accounts receivable by the amount paid, and we will debit cash for the amount collected. So in this example, we'd have 1,800 for the total accounts receivable on the balance sheet, and total revenue being 7,850. Now, as we go through the accounting cycle, the beginning of this is going to be those underlying economic transactions, and we're going to record those transactions by using a journal entry. And we may use our T accounts to help us calculate the amounts. We will collect our debits and credits in a trial balance, which is what we'll use through that trial balance to prepare the financial statements. So next I want us taking a look at a couple different measures we may have to glean a little bit of intuition as far as what this accounting information is telling us. The first is going to be a profit margin. So this is going to be, the formula is going to be net income divided by net sales, and will tell us for each dollar of revenue that the company is able to pull in, what percentage of that is actually going to the bottom line, is actually going to net income. And here, in this example, we can see Visa and MasterCard as examples. So we may not know with just one number in a vacuum whether that's a good number or a bad number, but the two things we can do is we can either look at it against a competitor. So here, 36% profit margin for Visa, comparing to a competitor of 31%, we can say that we've got a higher profit margin than that competitor. We can also look year over year at our prior performance. So here, looking a year ago at 40%, 2 years ago at 46%, we can see we've got margin compression. So we've got a declining profit margin. So every dollar of sales we've gotten coming in year over year, less of it's going to our bottom line. So comparatively throughout time, it looks like we're not doing quite as good from a profitability standpoint, but we may make up for in other facets. But compared to our competitors, we're doing better comparatively compared to that competitor. And they are, it appears, going through the same thing year over year. The other ratio we want to take a look at is going to be the current ratio, which is going to give us a measure of current assets to current liabilities. So this is giving us a sense of, do we have enough liquid assets at our disposal to pay for certain obligations maybe coming up within a year. So a higher number is going to show that we've got a better situation as far as being able to meet those obligations. A lower number that is going to be a little bit more tenuous. And there's no, even though one kind of shows that our current assets are going to meet current liabilities, and it's easy to kind of think about that as a target number, really you want to thinking about it in terms of where are the competitors and kind of where are we year over year, and also that it's not directionally one is necessarily better than the other. If we have too much current assets on our balance sheet, yeah, we're going to be able to meet those liabilities, obligations associated with those liabilities, but we might be being too conservative there. We might be being a little bit inefficient and wasting our assets. And if we have too low of current assets, there might be a risk of not having enough cash to meet those current liabilities when they come due. Comparatively, in this example, we can see that Costco has a higher current ratio than Walmart, so a little bit more conservative that way and a little bit more secure in terms of meeting those liabilities. And that we've stayed about the same year over year. So compared to 2 years ago, it's a little bit lower. Compared to 1 year ago, a little bit higher. So it's about trending at a kind of a neutral, whereas Walmart is declining year over year from 0.97 to 0.93 to 0.86, maybe being a little bit more aggressive year over year with the amount of current assets and liquid assets they keep on their balance sheet compared to the liabilities that they have due within a year. And that is going to conclude the lecture on Chapter 3.